Why is China's economy slowing down? This is a question that has significant implications not just for China, but for the global economy as well. To start, let's look at an interesting fact. In 2021, China recorded its slowest GDP growth in over 4 decades, expanding by just 8.1%. For a country that regularly saw double-digit growth for years, this slowdown is quite remarkable. There are several factors contributing to this phenomenon. Firstly, China's previous growth model of investment and exports now has less room to run. China became an exporting powerhouse by producing cheap goods for the rest of the world. But as wages and production costs rise in China, it is losing its competitive advantage in low-end manufacturing. Countries like Vietnam and Bangladesh now offer even lower costs. At the same time, China's focus on massive investments funded by debt drove growth for years. But it has also led to overcapacity in things like real estate, factories and infrastructure. Chinese households simply can't consume all that excessive production domestically. And many emerging markets saturated with Chinese exports have slowed down as well, further dampening demand. Essentially, China is now facing the limitations of its previous growth drivers. The old playbook of exports and investment-led growth has run its course. China knows it needs to shift towards a consumption-led economy with higher value-added industries playing a bigger role. But this transition is proving difficult. For one, Chinese consumer spending remains subdued. This is partly because income growth has slowed in recent years. High household debt levels are also acting as a drag on consumption. Political and demographic factors are also at play. Under President Xi Jinping's zero-COVID policy, sporadic lockdowns continue to disrupt economic activity and consumer demand. At the same time, China's aging population means the share of peak spending consumers is shrinking. Strained relations with the West are further hampering China's economic pivot. Restrictions on acquiring overseas technology and brands have made it hard for China to move up the value chain. Western sanctions in response to China's human rights record have also taken a toll. With a skeptical West, China lacks full access to the global economy's most lucrative markets. Let's recap the key factors: the diminishing returns from exports and investment, muted consumer spending, adverse demographics, zero-COVID policy, and tensions with the West. Together, these headwinds have slowed China's growth remarkably. Looking ahead, China faces difficult structural adjustments. It has to reduce its dependence on debt-fueled investments and low-end manufacturing. The private sector needs to become the main driver of growth and innovation. The country needs to pivot towards a more modern, high-tech economy. Undertaking these reforms will be politically challenging as well. It remains to be seen if China's centralized, authoritarian model can sustain innovation over the long run. Greater economic liberalization will be required, even if it comes at the cost of political control. In the meantime, the rest of the world must brace for slowing demand from what was once the world's fastest-growing major economy. With China consuming over $2.5 trillion of the world's exports, its reduced appetite will impact global shipping, commodities and supply chains. Countries like Australia, Brazil and Germany, which are major suppliers to China, will feel the effect. Emerging markets in Asia and Africa, long dependent on China's investments, may also struggle to finance their growth plans. The economic slowdown will likely mean China's global influence will increase at a slower pace. Of course, it will remain a formidable power given its enormous size and resources. But reduced growth may encourage China to focus inwards for the time being. While a slowing China creates uncertainties, it also presents opportunities. Other emerging markets could benefit from a partial manufacturing shift away from China. Chinese capital too could flow overseas in search of better returns. China's economic slowdown is neither sudden nor temporary. It is the result of structural shifts that have been building over time. While not good news for the world in the short run, it may incentivize much-needed reforms. How China addresses the challenges ahead will determine its growth trajectory for years to come. I hope you enjoyed this video. Let me know in the comments what other global economic topics you would like me to cover in the future. Don't forget to like, share and subscribe for more content like this. Thanks for watching.